Greetings, greetings. Welcome to this week's macro measure. I'm Wayne. My partner Ryan is working on the market outlook overview. It'll be going out later today. It is Sunday, March 19th, a little in front of 11 a.m. on the East Coast. And once again, welcome to the market rebels out there. This is our macro measure video. I am just going to get underway, folks. Disclaimer, flash that one quickly, please. Let that burn into your mind's eye. And then please take a look at an intellectual property rights notice and make sure that's singed somewhere as well. And then let's get into the important stuff, like the quick recap and so on and so forth. So this is all the stuff that I'm going to try to cover. And I just want to say the reason I'm just getting started is because the last several weeks have just been so chock full of everything. Remarkably interesting technical junctures and facets in place, complexions, on down to the news, the risk, everything. It's just been, honestly, it's very, very interesting on the one hand, but without a staff helping me, I don't feel like I just can't cover everything or even come close at this point. It's just there's too many things in motion, too many variables, too many news items that are worth focusing on. It is really, really amazing, but an amazing time in so many ways. But I just wanted to note, right, the quick recap. Last week, we really just said, look, we expected volatility, right? We weren't sure about having a strong lean, and that was pretty much it. I don't think I need to really belabor that. It was very interesting in terms of the trading between, the early gap down in the week, the attempts to rally, the failures of that. It's just been remarkable. But there was a lot of things that we need to go through that are probably the least worth just talking about and touching on. It's just going to be a smattering of a lot of different things, and we'll do the best we can. But in the end, right, we could save a lot of time, which is line 2 up here. We could save a lot of time just by noting, right, that probably the week really hinges on that FOMC reaction. What they do and how the market takes that. AJ brought up that issue, of course, on cocktail hour, and it was, it's certainly worthy of discussion. I am not a Fed expert. Ryan and I commented with respect to AJ's questions, and I think we were both in the same camp and expecting 0.25 given what's transpired in the financial system recently, not only here, but in Europe as well. So we think that would be the lean. But again, I don't know how the market reacts to that. Maybe the market sees that as a win. Certainly the NASDAQ seems like it's already pricing in that kind of a win. But again, I wonder if what we're really seeing is the same old, where you go in, you lift those mega NASDAQ names, and then after you do that, you save the market because you've been able to basically paint the tape enough. But that's a whole nother discussion, really, beyond what we talk about here, but something we'll just touch on. So let me just quickly stop the share, and then we will switch over to, let's see if I can get this to work here. It always kind of fights with me a little. I want to get this out of my way. And then we'll have some notes here and there, and I can just show you a basic chart. So let me get the share started again. And that should be screen 4. So what I did, which I don't really do that often, is I really just took everything off of my charts and went with this really basic look. And I thought it could be helpful just in case we have some newer folks, and maybe just taking that step back, right, and away from all the different analytical techniques and indicators. Maybe that'll help us too, and maybe just maybe it's appropriate. So it seemed like a good time to do that, and I'll discuss why. So we'll start where we typically do, which is with the spiders, but they were not really the most interesting major index ETF that we chart last week. I think that was definitely the Qs, but the spiders, right? What I wanted to do is to show, right, that we all know we've had this long incoming trend that led to the start of 2022, and then we had this sort of in 2022 we had that broadening corrective action, right? That really began really with the start of the year. And we can now draw a few lines back in just to show that this is what I thought we would do. And that gives you an idea, maybe right about there, just something like that, right? And then we'll do it over here with this kind of broadening corrective action that was looking like this. And we could just to be fair about it, we could probably put another line in, clip off one or two candles a little bit and show that right there. But this was, I think, our first tip off, and luckily things were pretty bombed out there. And we were able to note that there and there, actually, that with some of the things we'll look at, market was pretty bombed out and probably due for a rally attempt. Now, it's always hard to say, well, where does it get to? But it did manage to get to really the resistance line. And so we've been calling this the bear market downtrend line, this one right here that I just highlighted and modified. And so we're still really in the oops, it didn't keep that for some reason. We're still really in the vicinity of that. Let me try to get it back on track right about there. So I think that's close enough, and I'll expand this, of course, as well. So that's the bear market downtrend line we've been working with for a long time, and you're still really right near it. I mean, I may not have drawn it perfectly, but it's still in the mix. And the only other things I've got on here besides these trend lines is I've got the light blue 20 SMA, the goldish 50 SMA, and the purplish 200 SMA. These are just basics, but I just thought I'd leave those on because just the way that a lot of people like to focus, right? The SPY, interestingly, tried to get back up to and through the 20-day there in light blue, couldn't do it, and then fell off Friday. The 50, however, crossed above the 200, and that's something people like to see. Again, I'm not big on it personally, but that's something a lot of people like to see. And it's still there, right? It's still above there. And we can easily be back above the 200-day in purple with just a little bit of positive action. In fact, one strong day from where we closed on Friday could put us above all three of those SMAs, which are fairly widely followed, right? They may matter to some people in terms of how they're going to approach the market. But I would argue there's probably another resistance line somewhere around there as well. So that 50 days is a big deal. There's a resistance line there, I think. And there's also this flatline-ish activity that's up near 405. And we've had plenty of 408, 409 is a big level. We could go into all that, but it's not even worth it right now. What I'm really trying to get at is this is not that easy, because if you look at it, you're so close to some things that could result in folks changing their views in terms of the action, right? They might say, well, no, we're still in a bear market. I happen to think, given my macro take on things, this is not over. That's just my take on it. If we eliminate this one candle and kind of come through here, right, you're still below this line as well, right? I think that's a solid line. I think there's also a support line here. And you can see that you're really deep into what a lot of folks would call a triangle, right? There's a triangular nature to what's happening here. But this is why I keep saying interesting. This low is higher than this low here, which is higher than this low here. And this did make a higher high, yet it wasn't able to hold onto either the bear market downtrend line to convert it to support, nor was it able to hold the 200 for very long. So those are sort of like not good signs, but at the same time, the structure itself is still flashing. Even if we don't like that, it's still flashing higher lows and a couple of higher highs here. So that is why I think it's interesting and not easy right now, because if you look at that, it's tough to argue strongly, very strongly, what's going on one way or the other, to have super, super high conviction on it. And this is just based on just a few of the techniques, right? There's so many other things we could do. But one thing I like to look at is cycles, and it may not seem like a great week for stocks, but you look at it, right, they open things low, they pushed them up pretty strongly, and they held it somewhere about the midpoint, maybe a little bit more towards the high of the week. So overall, you could see that theoretically there was 4 days generally of more of buying there rather than selling. So again, you can argue, and then we could do this with a lot more firepower, but the Fed's announcement and the Fed reaction, we all know that's likely to determine what happens next. And could this be more, right? Could it be something that's bigger? And so some people may not see it while others would, where if you just label this the head, this part of the price action right in here that I just sort of moused over, I don't think it'll let me just freehand it. There's nothing I can do to really freehand that, but on Thinkorswim at least. I don't know if it, you know what, I wonder if I could use the annotate tools, if it lets me just do something here. But yeah, you get the idea with this. Now there's that. And then, right, this would be a shoulder, and then this over here would be a shoulder, but then we could maybe have a compound situation possibly brewing here, right, where you have two shoulders on either side of the so-called head price action formation. So again, don't want to rule that out. Let me see if I can now figure out a way to clear up everything, erase this stuff. Well, let me erase it. Come on, man. Eraser. Well, I'm not sure if I double click on everything, it erases everything. Well, maybe it does. Okay, a little bit clunky, but oh well, at least we had something. So the point is that we could hem and haw about this. Let me get out of that. I don't need the eraser anymore. Get rid of annotate. There you go. All right. Or we can just say, look, the reality is that this could go either way, right? We just saw that if you believe at all in patterns and inverted head and shoulders, compound, regardless, these do have a better probability than a lot of other patterns. So that's certainly possible, and it just hinges on so many things. So that's the start of our discussion in terms of SPY. I mean, it's pretty hard just stepping back again. You're back in this broadening sort of corrective formation. You're below the 200 and the bear market downtrend line right now, but you could be above everything and through easily. At the same time, you could break down below here. It would be another test of this mid 370s ish level in the SPY, and then that really probably opens you up to a lot more downside. So things can change very quickly. I said I thought this was going to be a year a lot like 2022, where there'd be a lot of up and down, a lot of volatility, and it just much like 2022. Right out of the starting gates, we're getting that. So I again, you just can't say what period you expect that to be the case, but it's just been a very good trading market if you're willing to take solid singles and with an occasional double, just to use that jargon, from baseball, where you're not swinging for the fences. So it's been pretty good that way. I can drop another line on here, and then we could say, well, if we look at this way, then that's just a corrective channel that's set the bull trap. So that's one of the notes we have this week is, right, is the bull trap still possible? Yes. But is it also possible that there could be an inverted compound head and shoulders that's unfolding here that they could possibly put to work for them? Now, if we jump over to the QQQ, the QQQ has been the standout lately, right? Before, if we go back a while, it was IWM, and now it's the QQQ. So the gang is doing what they do, which is to rotate to try to save things, and this has been going on for a long time, and we could just say, okay, I don't want to draw all the drawings and put them all back, right? But we'll just talk about sort of like the channel that we've been in here overall on this way. Come on, there we go. So we could say, well, there's sort of a channel forming in the QQQ, and that could also be a corrective channel if it fails here. But it could also be one that if they break out and through, right, that could be the start of something. So this is why I think you just can't rule out anything. I do think that I'm not a big believer in this. It doesn't mean I wouldn't trade it long. I mean, we've been trying to go with the market all the time. That's what we've always really done. But what I would say is, right, I have a lot more confidence with this market correcting, because I just don't think that this economy is heading in the right direction in a lot of different ways. Now, that gives me more conviction on the downside, but the downside is harder to trade, in my opinion, than the upside. So I would love to be wrong about my concerns, and I would love to have the market really start to get back to rip roaring. And the one thing that's been consistent when the market has rip roared has been the Fed put, where they come in and assure everyone that they'll save everyone. That's your moral hazard that everyone clamors about, and probably rightfully so. But really, right, we know that when there's money finding its way in from essentially, right, from some form of Fed support, I don't want to call this QE, but who knows what's next. But when there's money flowing back in, when there's increased liquidity, it seems like it finds its way into the stock market, and then stocks go on a binge, right? A binge to the upside. And that could be the case. If I would say, look, if the Fed is really worried and they really back off, they're again between a rock and a hard place. So I don't want to belabor my notes, but they're between a hard. I had that here. I'll just leave it like this. But they're between a hard place and a hard place, right? Because, and I've got that down here, because now you still have high inflation, and it's possible that maybe they are going to be cutting rates, right? So I don't think they'll cut them. I could be wrong, but I don't think they'll cut them this time around. But I just think that the chances of them cutting rates seem to have dramatically increased. So even though I'm doing this a little out of order, I just want to jump ahead and just show everyone some of the tabs I've got prepared in my browser. So here is the current Fed meeting that's set for Tuesday and Wednesday, with the announcement coming on Wednesday. And so just notice where you were 1 week ago. 1 week ago, there was zero chance, the way the markets viewed things, probability wise, zero chance that we stayed where we are. Now there's a 38% chance that we just stay where we are. The jump up by 0.25 seems to be have gone from 59 to about 62. And then the chance that you jump up more than that seems to be went from 40 to 0. So it looks like the guesses we put in on cocktail hour seem to be the favorite guesses, where you get the 0.25. But there's also 38% is not chopped liver. And so that's a big change. And if you look out later this year just to see what happened, let's just jump to, I don't know, we'll jump to September, for example, and you'll see where the rates are. Now, look, the highest one is that we're down. The highest probability is that we're down from where we are now. And so Lotus, right, 1 week ago, all these probabilities were that you were higher, higher, higher. Oh, they're all now 0. So the market really thinks that more than likely you're down in one way or the other from where you are right now by September. So that's a big shift that we saw there. And so that could be the kind of thing, right, that gets them going, where they at least try to act as though here comes the Fed all over again. We're back in the liquidity. Happy days are here again, and you do get some of these bullish possibilities, right? You do get these bullish scenarios playing out. And the thing is that there's plenty of gaps that were left on the way down. You could see those plainly in this chart. I'll just make it a little bit bigger, but you can see that plainly where my pointer is, that are still there. And by the same token, there's plenty of downside gaps on this stuff too. So you could say, well, what are they going to fill first? If you're somebody that believes when there's a big change that or another leg that unfolds, there's a gap. But there's gaps, and that's when they matter. That's how I view them. I don't really view them as that important once 5 days has passed. But when you're trending strongly and there's been a big sea change, or there's a route happening, that's when these gaps can matter, and I start to factor them in more. In other words, like what I'll do is I'll look at, instead of kind of going slightly out of the money with maybe an expensive vertical spread, I'll go further out of the money because I can pay less and still have have less dollar risk and still have a massive score, probably a larger score, by structuring things that way. But that's a whole nother discussion. But yeah, I mean, you could see that, look, this action's curling up, higher lows, SMAs, people would say probably they like that SMA complexion, right? The way that those are shaping up. So once again, you can't rule anything out. I think you have to really wait it out, and there's just nothing we can do. There could be some decent trading in front of it. I don't know what is going to happen in terms of the banking situation over the weekend. It seems, last I heard, there wasn't anything extraordinary that was being worked on. But if the IWM is the thing I just jumped to, and that's kind of led the way, I feel like the market has sort of been following the IWM, where when we were still hanging tough and rallying in January into early Feb, that was looking really good, and the market overall was. And then this really started to slide, and it slid very strongly. You can see it's right at a big support level. And so if this doesn't hold, this would, you're looking at lower levels. And that's been something that's kind of stalked the markets. Now, could they decouple from IWM being the leader? Sure, they could. And I think they're using the QQQs, like I put in my notes there. I think they're using those big XLK. So these are a couple sectors that are working, which I'll talk about in a brief sector situation video. This is really still mostly about macro, but the XLK, the QQQ, right? The tech heavy stuff, this is what they really use to, I think, make things look better. And these things are back at highs. If you look at this chart, if you look at that, why would you, if you looked at it in a vacuum, I should say, I would like this chart. I'm not saying it's an immediate buy, but if this thing were to back off small and then start to get ready to go again, it would be very close to critical resistance levels, and it probably would take some of the overboughtness out of it short term and then start going again. You've got the SMA complexion looking the way that it does. You've got the price structure looking the way that it does. I mean, I would typically like that, right? And you could see here that it seems like volume was picking up. A lot of these basic signs that you can look for. There's a gap, it could go up and fill easily. You've got that kind of a thing to at least get a single out of it. But this area, right, similar to QQQ, this looked pretty good. That's, I think, what they're doing, which was really what they did throughout the 20 and 21, and tried to do at times in 22, which is just come in for the big players, and that'll paper over, right? It will mask the weakness that's really out there underneath everything. You can see even XLC, I think a lot of that was Meta. I think Meta is a big weight here. Now, that doesn't look as good as XLK, but this is what I mean, that by them using that. The rest of the sectors didn't really perform all that well. We'll talk about some that did in the sector situation, but these did not, these were the real standouts. And I think that another thing that kind of, so if you look at XLF, this will be another thing that I would note that, right, we've talked about this, the financials being in such dire straits is not a good look. And it's very difficult for the markets to do well when the financials are experiencing turmoil. If another thing that makes it hard for the market to do well is, this, or is indicative of a market maybe that's running on not such strong fundamentals right now, would be energy. And we were trying to stay out of this for as long as we could, put a couple trades in here and there across all this consolidation, but it left that sort of triangle that we were talking about and have traced out there, and it's been really rough, and then dropped below the 200, been really rough ever since. So fortunately, we were able to get some things in on that, on the EOA Pro, in terms of like HAL, Schlumberger, XOP, I think we had maybe a couple others that really slid off nicely. But that was something that I'm almost just glad that we didn't get pulled into too many ideas when this stuff was doing its thing for a few months there, because it was very choppy and not easy to trade from day to day. News was impacting it. You just never knew how long any kind of move could sustain itself. There were so many reversals that were happening, but that just doesn't look good. So financials do not look good. XLE clearly not looking good. Here's your transportation sector, right? Not looking so good. This is really sector situation stuff, but it's worth mentioning here in macro measure because these things I think matter. That's why it's worth keeping an eye on things. On the flip side, one thing we can say that's held on, and again, this is probably due to the news developments. It seems like just like 15 years ago, CNBC kept drum beating. In so many words, I summarize it as we're going to smartphone our way out of this. That's what they would, smartphone talk all the time and how great it's going to make everything. Well, now I guess it's AI and chips that will support this stuff. But you can see, I mean, that's SMH there, that held on really strongly, barely closed off the highs of the week overall. So that is still trying to act well, right? I don't know if we've had to look at other factors here, but I don't want to start charting that right now anyway. But the point is that big tech and the SMH looks good, but a lot of the traditional stuff that technicians look to say this economy, what's up with the economy, are things looking good? They just don't look good. So despite what's happening in rates right here, despite that, things do not look all that great on more of something akin to more of like a Dow theory basis. We talked about stuff like this last week. Let me see if I can get my so wait, there was one, not that one, this one. Yeah, so I wanted to talk briefly just about the sentiment. And one reason I think it's been so difficult to get stocks to come off in a big way is because of how negative the sentiment is and how obvious things are. And I know that sounds stupid to a degree, but these guys really feast on frustrating people, and they really feast on forestalling, the obvious from happening. I've seen it many times in my career, and so it's frustrating to me as well. But you can't let it get to you. I just that this is part of the games they play. But just with so many people in, let's say, our camp, my camp, where Ryan's camp, where you just see so many more negative stories that you believe are going to hit the tape this year, and employment supposedly being full, right? And again, with inflation as high as it is, with prices as high as they already are, with interest rates as high as they are, and so on and so forth, I just don't see this turning into a rip-roaring economy. The market, of course, isn't the economy. So that's why it's so difficult to always, you don't want to impose your macro take on your trading. Now, you can do that probably for longer term stuff and maybe be better, win better results. But if you try to apply that in the short run, these guys will chop you up over and over and over again, because that's what they're really good at. But this is one of the reasons why I don't think we've really gotten smacked. And I think that there was also the thought that, well, if it's really that bad, the Fed's going to shift. And it appears that the markets think the Fed really is shifting and shifting quickly. And this is part of my series on, joking, of course, my series on position management. So I threw this into the pit midweek, just to let folks know where we were, right, on this imperfect CNN fear greed measure. But we had gotten down to a level, right, where we've seen other lows get put in when we've gotten to this point, like pretty big lows of 2022 that were very tradable. So that's what I threw in there. Another thing I threw in at the time was this, and then I also threw in this as well, which is from our own website. And so these picks just show you where we got down to in terms of percentage of stocks above the 20 SMA. And all I want to bring up here is that you've got to be on guard, because when they get things, you need to step back or keep an eye on these things in some way. Because when you step back and see where all these things are, it's not that a rally should start immediately. It almost did, but that's not the point. The point is that when things get this way, the Pavlovian response to start buying is still so strong because of the buy the dip mentality. Really 2 decades almost of buy the dip mentality have created this. It's very hard to break. And so these guys come in and in the face of everything, right, they'll turn and burn. And that's exactly what they did on Thursday. So we were, fortunately we noted it, we were ready for it. I don't always have the time to share this information because I'm busy with so many things, but even still, where we finished, this is where we are. So the message that I like to share is just be disciplined, right? Just think about at least getting a roll in. If you're riding 80, 85 delta puts and you've been right, it's been doing well, and you know that you get near support, you know that all these types of things are in place right now. It doesn't mean it can't crack. At times it will, but there's many, many times where these guys will frustrate the living daylights out of you, and then it eventually cracks. I would say they frustrate you far more than it really cracks. So probably the odds on bet in most situations is to at least roll to the at the money or slightly in the money, preferably really. If it's really oversold, you're seeing a lot of extremes, I would say overroll into the 35 delta puts. And then if they start to hurt you on those, it's a lot less painful. You can react, get out, and get ready to get back in. But just the point is is DDA, discipline dictates action. Do something so they can't do what they typically do to people that, let's say, are so into the trade they don't see that big picture developing. So this is also just a share on the sentiment survey, right? This came out just a few days ago. So note that optimism is at a 6-month low. And I don't want to get into any weeds on this, but this is part of the reason why I think they've been able to frustrate so many people. So many people are positioned that way, and they're the masters of finding ways to frustrate people and get people to give up, capitulate, throw in the towel, all that kind of thing. So just wanted to show a few things where in UOA Elite, just wanted to show there's been a lot of things that have started to pick up and trade. So people ask about things like LQD, HYG, IYR. Well, there you go. There were 3 hits there. There was big hits all week long, pretty much in some of these ETFs, but SPY and IWM were pretty big. The Qs, notice they actually bought a call spread, and look how they did on that. So I think it was, call spread. But this just gives you an idea how busy it's been. There's been a lot of big things happening there. And then as far as the UOA Pro service, right, we've had a lot of the financials. We had, again, energy falling. This is, I think, where your sector work can really come in and help you. Had to add a lot of additional levels in some of the financials because they've gotten hurt far more than we anticipated initially. But that's just a little bit of the flavor of what's going on. So I'm going to keep putting in the ideas for anytime I can get my hands on a good ETF, major index ETF trade. I'm going to put those in to sort of allow people to have something to trade around, right? If they don't see anything setting up in the individual names. But that we did see a lot of that. We've also seen, which I wanted to mention as part of my notes, you may have seen it, that while the XLE was, I would say, slam-boozled, the XAU, on the other hand, has been a real powerhouse. And I'll show the chart on that, but I'm trying to bring up, it didn't give me that. I thought I put a couple updates in on XAU. It may have just been XAU, my bad, I put there. No, it's not giving me anything. But we did have UOA in SLV, GLD, other things. I could try to maybe search by metals and see if I can get anything to show, just to give you an idea of what's happening. So this is important. Here's a lot of real estate that's potentially vulnerable that I didn't mention. So here are some of the metals that have shown up in the UOA Pro log. Now, there's more, of course, in UOA Elite's log, since that's the source of everything. But you can see that there's a lot of updates to existing trades or just general information updates. And we've had, some ideas in there as well. And the reason I'm mentioning that is, right, oops, wrong thing. So here we go, back to XAU. XAU is an absolute powerhouse. Last week, if it comes up, I mean, it really had a strong performance. If you think here's the prior Friday, right, and this is where you got to as of Friday. So the gold and silver index took off, right? XLF, as we noted, was still an XLE. We're still really in trouble. And the point is that, look, that's telling you how defensive the market is. Again, the only thing I can really share that just quickly, because I'll talk about all this in sector situation, and that is not it. Where is it? Here it is. Yeah, so the only things really that were hanging in there are the Tech XLK and the XLC, like we noted. Everything else pretty much rough stuff. So just got to mention that, even though this is macro measure, because it just shows you the way that the funds are flowing throughout the market. So I guess the best thing to say would be that we're still doing risk off, right? In terms of like trying to summarize everything, because there's so much out there. The market, I don't think you can like the complexion of the market, the way the sectors are looking, things like that. This, on the other hand, right, the spiders are in a triangle. The Fed can determine, is probably going to determine which way we break out and move for real. If you try to duke it out between bullish points and bearish points, I would say there's slightly more bearish points, I would say. And I think the bears are more in control still than the bulls are, but it all hinges on how this reaction takes place, right? So we did have that. I don't know if I could find that one graphic for us, maybe here, but I think I had it somewhere, which was, is it here? No, where is that? Oh, no, not there either. Sorry, I apologize. I thought I had that one graphic that we shared last week. You know where it is, actually? I think it's in the slideshow. That's where I think I put it, actually. So let me try to just redo that. Let me start this back up. We'll come to here. I know we're on like the different view, and I'm not going to worry about it. But remember, this is where we are. So notice, right, what happens when the Fed finally starts cutting rates. And if you want to think about this, well, why would we go into these gray recessions when the Fed starts cutting rates? Because that's when it becomes obvious to everyone that the Fed probably stayed too high for too long in most cases. And now, right, they're reacting to data that's going to be hitting the tape in the future, or is hitting the tape now, that's not very good. And so the leading economic indicators, I had that too. Let me get back to our browser. I'm sorry to jump around like this, but let me just, I think I've got the leading economic indicators up here somewhere. Yep, here they are. And now this might not be completely current, but you can see that the LEI, year-over-year change LEI, is blue. And then here's your year-over-year change real GDP. So LEI is clearly a more volatile, but overall there does seem to be some kind of a correlation. And you could see, right, where GDP is now, and here's where the leading economic indicators are. So between that other graphic where the Fed cuts and we see things get rocked in the market because the Fed's typically late. Now we have to say this time they're really between the old rock and the hard place, like we said, because so it's a little bit different. I'll give them that. It's a little bit different, but the reality is that this is definitely caused, or at least it seems to be related to, when you get the recession. So that's the hard place, and hard place they're at, right? They've got still have not brought inflation under control, and they have an issue where the system itself is showing potentially major cracks. People have been wanting to get this pivot, but again, That's the slide I just flashed. So be careful what you wish for. And so all that together, we have a situation where, despite it all, technically, right, all it would take would be one nice pop above the 50, and every SMA will be to the downside. And to go back to our simple chart right here, every SMA would be to the downside. And we could say that would be very little there, right? You'd be back in the channel. You might even project up to the other side of the channel, which could be somewhere up there for high 430s. Again, taking out this one. And you, in my book, you still wouldn't be out of the woods in terms of, are you still potentially in a longer term bear market? Because I think this is the part where most people finally would capitulate, saying, wow, they got it past there. That's probably on their way. Lower rates are going to work their magic. The increase in liquidity is going to work its magic. And it very well may. I'm not even saying it wouldn't. I'm just saying that if you were going to pull a masterful trap on bulls, that would, I think, be the thing that really seals the deal for people. And so remember the third year, too, of the presidential cycle, that got knocked off track with this banking crisis for the first 3 weeks, let's say, or 2 weeks of March. But they could try to put it back on track again by doing what they're doing now. If you said to me, well, what's your call, right? I don't like to make calls, especially because I think calls lock you in, lock your ego in, and you locking your ego in is not good, because flexibility to me is much more important than being right. I'd rather change my mind and profit than not change my mind and stay staunch and get myself in trouble. But bottom line is, I think that this should still, everything should still, there could be a little scare. I would think that this thing eventually rolls back over again. I still think that, given everything out there, I don't think everything's going to turn on a dime economically. I can't fight the fact, though, that there's a lunatic fringe that controls hundreds of billions, if not more, that's ready to buy everything at any time because it's other people's money. And at the slightest hint of anything bullish, they'll just come in and start going after things. So there's all that, but we can't rule out that, right, there could be even more to the banking, this banking issue, this banking turmoil, the banking crisis, whatever you want to call it. I still think, really, with the way that XLF looks, the way XLE looks, the way that the precious metals are being, there really is risk out there. Usually that creates a problem for folks in terms of businesses and how they behave if they think things are really not peachy keen, right? That's basically it. So with the increase in layoffs that we've seen, with the leading economic indicators where they are, I don't know if the Fed just slowing down a little bit and still leaving rates where they are really gets the job done. And that just assumes that that's what the Fed's going to do. But I don't know if that gets the job done and it's really up and away, although the reaction could certainly be up and away. So I think what I would try to do for this week, knowing that so much hinges on what we're about to hear from the Fed and this banking stuff, I would just try to trade in front of that and really reduce your exposure until the Fed passes and then subsides and you're back into a trend. Now, the problem with that is that the longer you wait, the more you miss if they put a big move together. So that's why I hate Fed weeks. I hate earnings season, because they upend the apple cart. They introduce things into the mix that we have to contend with. That's just not pure trading. It's really heavily influenced by things. It's not that natural kind of rhythm the market has when that stuff isn't upon us. I'd rather trade in the months that are not earnings season and trade in the weeks that are not related to the Fed, because I think you could tend to see it. There's a tendency sometimes in front of the Fed to kind of go into just churn mode, which isn't really fun for directional traders. And then there can even be dual-sided volatility the day of the announcement, the day after the announcement, and that can even get reversed by the time you get towards OPEX on Friday. So it really creates a lot of volatility. I think you just have to stick with what you have been doing and stick with the volatility overall. And the other thing I would say is, looking at it all, just kind of in the simple way we are this week, trying to mix in a lot of things to consider. I don't think the Dow looks particularly good. If you look at that chart, right, that to me was looking a lot better. And now I'm not saying that something decent didn't happen for it, that it didn't crack last week. But if you look at it as a picture, IWM, Dow, I should say DIA and SPY, they're not looking so wonderful. It's really all the QQQ. So that's what needs to probably stay up to mask things, because those are the heavyweight names in the indices. And that'll be something that all the talking heads could point to. But yeah, look at Apple. But yeah, look at Microsoft. But yeah, look at Google. But yeah, look at Meta. But look at Amazon. All these types of things. But I just don't see that being enough, right? I think that maybe that's not the place to pick your fight. Maybe stick with, if you do get breaks, stick with things that are weaker already, like IWM or the diamonds, or even the spiders, until you see maybe the SMH and the QQQ really coming under pressure. And if you see that happening and the rest of this stuff is still either stuck in the mud or performing poorly, that's the last thing. That's probably what goes timber and brings about another leg to the bear market, if we're going to have one. And I would say, again, if you have to make a call, not a high confidence call, but I still would lean towards this thinking, at least thinking, not positioning, that this is still not over yet and there's a lot more fallout. But again, everything could change with whatever they come out with. We just don't know on Wednesday afternoon. So just keep that in mind. I think it's just a week to be prudent. This might be a week where you just really go super nimble and you're happy just to grind out a lot of little tiny singles, and depending on how it unfolds, and you're not really trying to force something into a bigger win. I think that might be it until you start to see what the fallout really is there once the Fed's done. Then maybe, after that initial, usually crazy bidirectional volatility settles down, then maybe you can get something that is a little bit bigger of a trade that trends a little bit longer, when they start to really price in with whatever the Fed has done and whatever the Fed has said. So that would be it. I think nimble, prudent, discipline. That's the call when there's more uncertainty, or you're at extreme overbought, oversold. That's how I look at it. You've just got to become even more disciplined that way, and just do what you almost don't want to, which is take the money and run, because you're looking to make more money. But take at least most of the money and run would be the way I would handle those kind of riskier situations. So hopefully that helps a little bit. I hope that something I've shared with you in this whirlwind of a macro measure helps you out this week or in the future. Thanks for tuning in. As always, I'm sorry that we were all over the board, but this is a market and an environment that's really all over the board. So without going into technicals that could get blown up by the Fed, I think we're better off talking about that this week. So I hope that helped you out. Everybody have a great conclusion of their weekend and a nimble and hopefully nicely green week ahead of themselves in the markets. Thanks again.